Let's start with where we saw first, I think, which way is it? Is it trucking first, then rails first, or vice versa? But we started seeing a pickup in the summer, and we were talking to Steve Leisman earlier this hour about how economists are all over the map on what's happening with the economy kind of right now going into the end of the year. What is the trucking volumes telling you?
So you're right. We first started seeing the trucking volumes start edging up in late June, and then July was unusually strong. It was actually above June levels. That's not seasonally the norm. The strength in trucking has actually continued. We host a private trucker and logistics call every quarter. We hosted ours early last week, and everybody on the call was pretty bullish. And they're even calling for the strength to continue through the remainder of this year and actually into next year as well.
So it sounds like a V, but one of the asterisks people are worried about is that a lot of the demand we're seeing in manufacturing and trucking is restocking. In other words, that parts of the economy didn't have the supply they needed. There's this race to keep up with them. And that once we kind of achieve that, there will be a hangover, that the V becomes, more of a sideways move from there. Is there a way to tell how much of this is restocking versus kind of the kind of activity that can keep continuing?
Well, look, I think that's hard to pinpoint exactly. I mean, there's been clear restocking going on, and nowhere is that more evident than some of the port volumes coming into the West Coast. I mean, before the pandemic started, there was fears that the West Coast could lose as much as 15% of its traffic to some of the East Coast ports and some of the Gulf ports based upon some shifting trade patterns. Now they can't even handle the freight that they've got coming in. We had a contact tell us there's about 28 more ships coming into the West Coast than was expected previously. And that's really the port for quickest entry to start restocking some of the shelves. So clearly this is going on. But there's also, I think, some underlying strength, beyond that. We run two big proprietary surveys. Our first one is our proprietary quarterly rail shipper survey that's going and asking all of the railroad's customers what they think about expectations going forward. And we also have a Cowan carrier survey where we survey a bunch of private trucking companies. Now, the rail survey constitutes about $35 billion of freight spend. The trucking survey is about 25,000 private Class 8 trucks. And when you look at some of the economic answers in those survey questions, they were all pretty positive. In fact, if you ask both of them, are they more confident in the direction of the economy? Overwhelmingly, the participants said yes, they are. And even some of their growth expectations in those surveys were both better than we expected. And both surveys were concluded in the last 2 weeks.
So let's get tactical because, again, that is really useful information for everybody trying to figure out what's happening with the U.S. right now. For investors, I know you have outperformed on several of the rail stocks. I mean, what would your top recommendations in your sector be right now?
Well, absolutely. So our top pick in the rail space has been Kansas City Southern. We entered the year thinking that they were going to be best for growth. I think that's turned out to be the case. There's some rumors around a takeout. We don't necessarily know if that's going to happen or not, but we really like some of the early successes in the implementation of precision scheduled railroading. We love their cross-border growth that they've been showing. And also, we think they're well positioned to take hold of some of the nearshoring trends that we see. Away from the rail sector, our favorite name overall is XPO Logistics. We think this is a case of this company is going to either ultimately break up and realize value for the shareholders, or the market's going to catch up to the multiples of their peers. Right now, we think they're scheduled for earnings here in the coming weeks. We think it's going to be a very, very strong third quarter for them, and we like their positioning. And remember, they have about a 25% exposure to retailing and e-commerce, and that should help them out as well going forward.
Shepard Smith here. Thanks for watching CNBC on YouTube.